Hello everyone, good evening again. Sorry for the mess that happened. Unfortunately, it wasn't in our hands. We're also learning the perils of the technology, and we're trying to make it more secure by having everyone log in. So, because of that, it could take some time for the participants to join. But what we could do is I could still give a quick summary about what we'd already discussed, and largely why we are focusing on the premiumization theme. So, in a video a few months ago, I had mentioned that when the India's journey from $4 to $10 trillion has been mirrored only by two countries in the world, which is US and China. And when we look at these two economies and try to compare what happened within various sectors when US or China moved from a $4 to $10 trillion economy, which were the sectors that really benefited? One theme that stood out was the premiumization theme. And when we say premiumization, it largely means direct facing all the products, services, or tech which were directly facing the consumer. Now, this again, I'm trying to show a chart. Throw back to China's journey of $4 to $10 trillion, and which were the sectors that really did well. If you look at the jewelry industry, the luxury vehicle sales, or even the size of the private hospitals within China, these grew at an enormous 30% CAGR for at least 7 to 8 years. When you look at laptop sales or premium skincare market or high-end cosmetic market size, these grew by 22 to 25% over the 2007-2015 period. And of course, the other segments like luxury goods, wine consumption, even luxury travel, these were the ones which grew at 18 to 20%. Now, these are strong CAGR numbers. And what happens is within these, there are a few aspects that we try to look at. When industry is growing at 20%, and companies within it which have first mover advantage or which are providing the best services and they gain market share as well, the growth is far bigger, and the earnings growth in turn would be in the tune of 30 to 50% for sustainable periods of time. Uh, just to recap, there are three aspects that we look for. One is large part of movement from unorganized to organized. The second part is the mix improvement. So, uh, which largely means that you're moving up the value curve. And the third aspect is more luxury positioning, which is say 3 star to 5 star, or from a Timex to a luxury watch from Ethos, or going to clinics to moving to A category hospitals. This is a chart which is true reflection of what is going to happen. Earlier, there was a pyramid. A small 1% of the population used to earn more than 30 lakhs per annum, and 7% of population at 6 lakhs. In the next 5 6 years, these two categories will combine will more than 50%, which essentially means that a large part of the middle class population will move up the curve in terms of their per capita income, which would be anywhere between 6 lakhs to 30 lakhs, which is what will actually drive the entire premiumization theme and the kind of growth that we see. And we talk about the consumption sector. I think these are broadly how you'll diversify them or classify them. So FMCG services, retail, consumer durables, e-commerce, home improvement services, this is the broad category. The beauty is that we ourselves can, on a day-to-day basis, or we can see the trends changing around us. And these are the more look and feel, and we will know firsthand in terms of what is happening and whether these trends are available around us or not. And this particular chart essentially signifies that India is and will continue to remain the fastest growing consumption story within the world. And as a percentage of total consumption, we are still, in terms of per capita, we are still a very small piece when we compare to countries like United States and China. Now, when we are looking to invest in a lot of companies, we always look, one of our framework rule is we look at inflection point in companies. And when I say inflection point, it means outsized earnings growth to the tune of 25 to 30% over the period of 2 to 4 years. So when we look at the per capita trend, globally we've seen in developed economies and countries like China that when the per capita income crosses the $3,000 mark, which where we are at present, that is an inflection point in terms of the entire discretionary consumption trend that we've seen in a lot of emerging markets as well. And as per capita incomes grows, the share of discretionary consumption uh, grows multifold. So non-discretionary, which is basic, say soaps, paste, basic cosmetics. But when we look at discretionary, this segment sees a disproportionate growth when the barrier of $3,000 per capita GDP is met. Before that, it is largely the basic needs that is fulfilled. So these are the five broad categories. Consumer discretionary, which we believe it is at an inflection point, FMCG, where the mix change plays a larger role, the new age tech, uh, auto cycle, and of course, real estate. Now, when we look at the consumer discretionary trend, and if you look at the penetration levels just for India, and this uh, is multifold in most of the developed economies and especially China. Say a category like air conditioner, the penetration is 8%. That is also largely due to the power deficits or the last mile power connectivity issues that we've seen in the country for decades, which is slowly resolving. So we'll see a massive increase in increase of penetration within air conditioner, refrigerators, white goods essentially, and also uh, passenger vehicles and two wheelers. So this is a basic size of the consumer durables market penetration. If you look at APAC, China, Europe, you will get a sense on where India stands at a meager 3% versus China, which is 22%. So China is today, of course, a $25 trillion country. But when they were close to $10 trillion journey economy, this penetration was close to 13 to 14%, and we are still at 3%. And again, if you look at the part on the right, you'll see how the value migration is happening. So demand for fully automated washing machines, in terms of if you look at over the past 5 6 years, how the share of bigger TV size is increasing within the purchases. The force-feed refrigerators in terms of more than 270 liters, the larger size refrigerators, how their share has improved over the past 5 7 years. So this is a clear value migration that we've been seeing within a lot of products, segments, categories, and sectors. Another example is Alcobev, the alcohol beverage industry. Uh, if you look at our penetration would be a meager 1% say in wines, whereas China would have 4 to 5% kind of penetration in wines. So this is a whiskey category mix, and you see how the share of premium or above segment has increased to 34% in CY22 versus say 10 years ago it was just 18%. So this is the value migration that we've seen, and this will only amplify as we showcased in the chart where how the large part of middle class population will now form the bulge of the consumption spend. Again, this is consumer discretionary when we look at a QSR. If you look at eating out frequently, India stands at 4 times monthly versus China at 10 times. Look at the kind of number of QSR stores that we see today in China and US. And of course, the penetration level is something that we continuously talk about. So this again is a use case of why at a $4 trillion juncture, we'll see massive expansion in QSR stores and also the frequency of eating out, which is also seen in the numbers that Zomato has been posting. This is again beauty and personal care market. The kind of penetration and the kind of growth that we've seen from being just 8% in FY20, it has grown fourfold in the last 5 years. Same goes for apparel market. So these are clear trends that we are seeing across these industries. This is again new age tech that we spoke about, how the online market for beauty and personal care market stands at 8%. It might be slightly dated, but still we are far away from China and US, whether it is online grocery, online quick commerce, or online fashion. We still have, I think, close to, even if we double from here in the next 3 4 years, I think the growth is phenomenal within certain categories. Coming to real estate, we've seen a massive turnaround post-COVID. A very important chart, if you look at how the absorption and launches declined very steeply within the period of 2013-14 till all the way till 2018, where absorption declined by 23% and new launches declined by 50%. Now come to 2019-20 and post-COVID, while absorption of new launches has grown 48%, launches per se have grown only 38%, which means over the large part of inventory that was lying idle over a decade is being absorbed at a much faster pace than new launches. Again, this is fueled by the the rising purchasing power of each and every consumer. Of course, there are capital markets, there are businesses which we have seen transformed over the past 5-6 years thanks to the reforms that the present government unleashed post 2020, especially reforms like Make in India, China, that have aided the China plus one move post COVID, and reforms within the bankruptcy law that came in. Uh, Real estate per se, there was RERA, which dramatically changed the fortunes of the sector. So these are the sectors that largely get affected or largely get um, pivot when the real estate cycle does well. So from tiles to sanitary ware to wooden panel to white goods to paint, this is how these are the segments where we'll see that kind of consumption trend, considering most of the launches have happened over the last 3-4 years. And as the deliveries come starting 24, 25, 26, 27, you see that in the year 3, year 4, and on completion, what are the segments that will massively benefit. So over the next 2 to 3 years, we'll see a huge tailwind for most of these sectors. Now, let's take snippets from the Indian context to see what has already happened, and then we'll look at what could actually happen. So when we look at Ethos, a luxury watch retailer, the average selling price for them has moved from 84,000 to 1,89,000 in less than 5 years. When we look at Timex, the number of luxury retail stores that they've opened up is up 4x in 4 years. Looking at hotels, when we just look at the first quarter of 24, 36 new hotels came up with 2,300 keys. And when we look at branded hotels, the total number of keys that are there are close to 1,60,000. And most of these, so 75% of these were in tier 2 and tier 3 cities, which is what is driving the consumption trend. Again, when we look at ACs, industry sales were up 70% in May, and there was 100% growth in sales of residential ACs. A case study of Zomato, the gross order value has moved from 11,000 crore annually in 2020 to 48,000 crores in 2024. This is expected to grow at almost 30 to 50% over the next 5 years. If you look at the power customers, which essentially means people ordering more than 50 times a year, they have moved up from 9 lakhs to 34 lakhs within the same period. Coming to quick commerce, we've seen 77% YOY growth this year, and the estimate is 60 to 70% CAGR until 2030. We spoke about the television sizes and how we are seeing a product mix change there, and how it was just 3% 5 years ago. And when we speak to companies like Aditya Vision and EMIL, we get a similar feedback that the demand for larger screen sizes is far outpacing the traditional 32-inch and 48-inch kind of television screens. Coming to hospital beds, here also the kind of consumption trend that we are seeing is, you look at the average revenue RPOP which we see for most of the hospitals, how it has increased over the past 5 years. You see that from having just 62,000 beds 5 or 4 years ago, we are close to 5 lakh beds. In spite of that, per 1,000 people, we have only half a hospital bed versus 4.3 for China. I spoke about Aditya Vision. If you look at the bill cuts that grew over the past 4 years, we've seen a 28% CAGR in the number of bill cuts, which is basically the number of people visiting and buying more and more consumer durables or electronic products. And at the same time, the ASP moved up from 18.8 thousand rupees to more than 22,000. Even when we look at the trends in mobile phones, the ASP has increased from 10,000 to 18,000 over the past 3 years. So this is what we are already seeing, and this is a proof that we are seeing this value migration. We are seeing new categories emerge over the past 5 years, and how these categories will grow at 20 to 30% kind of numbers over the next 5 to 7 years. So how do we play this mega trend? So I'm not trying to take any of these names in terms of that these should be part of your portfolio. I have tried my best to show you what happened in China, where India is, what are the trends that we've seen within China play out, and what are the trends which some trends might play out very differently than versus China. But when we're looking around, when we're looking at a Titan or a Sky Gold, which is you can say a EPC of gold manufacturing, or a smaller jewelry retailer which is non gold, uh, like Gargi, or a luxury watchmaker like Ethos. You play the entire luxury or mixed change to these companies. If you're looking at retail, we've seen the kind of growth in Zudio, which is affordable fashion stores by Trent. We've also seen how Urban Fashion has grown their premium brands, and within this category, there are a few recent companies which IPO'd like Go Fashion and Vedant, and how they have performed. When we look at companies like Redseer, Metro Brands, which essentially is not shoes anymore, but a lot of accessories, which is brand concepts as well. These are the companies that you should play this mega trend for. Aditya Vision, EMIL, or Core, which largely I think deals with the rising or the bulging use case, or the penetration power of going into tier two, tier three, and then eventually uh, the middle class, they're wanting more and more of electrical or white goods products, whether it is ACs, washing machines. So these are the companies that will benefit massively from that surge, and that is one thing that we are already seeing, and but I think this will continue for another 5 to 7 years. On the Alcobev, we mentioned how we are very, in terms of penetration, still extremely low versus the world average or even China, and how we moved up the value chain within the whiskey piece. So Redico, or a light blend, which listed recently, or Piccadilly, which is now become famous for the Hindi brand, or Sula, which is again one of India's foremost manufacturers of wine. These are the companies that will play out within this space. When again you look at consumer durables per se, direct plays could be IFB, Whirlpool, Voltas, or Hitachi. But I am actually a fan of, doesn't matter which company does well within the consumer durable space. We've seen a huge growth emerge thanks to PLI schemes and Make in India scheme, where companies like Dixon, PGEL, Amber, VOEPL, and EMS companies like Keynes, they've done exceptionally well to cater to this massive growth that we are seeing within white goods space. So these are the companies that we would love to bet on, and we see sustainable growth over the next 3 to 5 years. And then coming to Zomato or the QSR chains, in terms of penetration, that we saw a chart. There's MedPlus, which is online meds, and Nykaa, which is largely trying to promote its own line of cosmetics, and of course, high-end fashion. So these are the companies which I think, we would be largely playing for the premiumization and mixed change trend. We spoke about real estate, we spoke about building materials. There are a host of companies here. I think we'll try looking at companies like Oberoi Realty or Prestige, which so Oberoi would be say a premium, or Godrej would be premium, or Prestige would be premium. These are the companies that we would like to play within the real estate space. Coming to autos, we've seen that over the past 7 to 8 years, the growth in luxury cars has been close to 30% CAGR. When we speak to landmark cars, if you go through their presentation, the growth in first the second hand luxury cars is far higher than the brand new cars. So I think that will be another trend that will play out beautifully over the next 3 to 5 years. It has been well documented and seen in India already, so we need not compare ourselves to China here. And when we're looking at hotels, I think as the purchasing power increases, every person would want to move from, say, a Oyo to a Lemon Tree to a Chalet to a Hyatt to a Taj. And that value migration we are already seeing in terms of the product pricing that we've seen over the past 3 to 5 years in terms of the room rates. they have almost doubled since COVID, and irrespective whether it is in season or off season, I think these prices have largely remained firm for large part of the year. And then of course format stores which are focusing on tier 2 tier 3, the aspirations of the tier 2 tier 3 population, like V2 retail or DMart, or a lot of unlisted local players within which on our road shows in a lot of cities or capitals of lesser known states like Odisha, Jharkhand, Chhattisgarh. We've seen the kind of local entrepreneurship that has come in within this space, and who have 30 to 40 stores within their own state and are doing exceptionally well when we look at sales per square feet. So I think that is how we play the entire trend. And it is up to, I think, every individual as to which are the sectors or segments that we are comfortable with in terms of our own understanding, where we can keep the best tab on, where we are comfortable with valuations. And I think I've covered large part of the companies within this, but you'll have to build a basket of uh, these companies in terms of to play out the entire premiumization trend. And I think this is what I wanted to showcase, and I've largely discussed what we think will work. Let's take a few questions now over the next 15 minutes, and I'd like to answer to the best of my ability. Hello. Okay, so Rohit message that we have last year private consumption growth lagged GDP growth. Do you see this reversing soon, or would take a couple of years? Also, have we seen similar issue in China when they were in this per capita band, when couple of years consumption slowed down and picked up again? Or we would have premium top consumption growing, but bottom of the pyramid consumption suffering. So while the middle piece, or the middle class, or the middle class is moving to upper middle class and moving to the 6 lakh plus kind of bracket, I don't with a coalition government, I think large part of focus will be social welfare as well, where the bottom of the pyramid will also come into place. My sense is of the next 5 years, because of the coalition government and because of the mandate that the current government has received, I think focus will be to uplift them as well. So we'll see basic consumption themes within the rural side in terms of FMCG or two-wheelers to play out. But when we talk about, that the stagnating or lagging private consumption growth, I think this has to change, and this will change over the next 12 to 24 months. And we are already seeing it reversing. We are already seeing the kind of consumption spends and kind of demand across categories, and we continuously study these on a monthly basis or a quarterly basis. So I think on the consumer side, we are seeing strong trends across. Karthik has asked, hi Piyush, do you track the stickiness of a brand for a consumer facing brand? As the taste of the consumer is always changing and sentiment can change very fast. So, one thing that we were taught is that, it's not what a brand would want to, a brand would want a perception of its own brand for the consumer, but it is not what they want to perceive it as. It's largely what a consumer perceives it as. A classic example being Toyota Police. They always try to bring it at a premium as a premium vehicle, but it ended up becoming a cab. They continue to do that with Innova as well, but the trend followed. Sometimes the perception is what the consumer creates. And this is something that we have to, so largely when we say a consumer might move from a Voltas to a Hitachi or a Blue Star. So we like to play players which are unmoved by this kind of consumer preference. We like to participate it via ODMs or companies which are actually are white labeling this for the larger brands. So look for companies that are kind of the EPC model, where they are taking the working capital risk and they are building these white goods or the products. And irrespective of which company does better, large part of this segment will definitely do better. And understanding a consumer brand or even building a brand can take decades. And you could look at Redico, and that's an example where it took almost 20-25 years to build one brand, and in the span of a decade they have five more brands. So I think that is something that keeps evolving. Indri is something that became famous in less than 18 months. So you have to track these trends carefully. You have to track what brands are being perceived as good or bad, but of course, I think that even a brand, most of these brands are very conscious today, and I think that should not worry you. I think focus on who is helping them create these brands. Darshit is asking your top picks and why you like it. So I'm not trying to. I would like not to name a particular stock. If you look at this slide, there are a few points which are bold. So these are the segments that we really like and we believe that will do well irrespective of any consumer preference change. And Nisarg is messaging, hi Piyush, were the stocks in other countries traded at such high Ps like they are trading now in India? Given such huge SIP flows that we are seeing when they transition from 4 trillion to 10 trillion, is there a data where we are able to make such comparisons? Now, the only way to back it is that when we did our study, so you look at the market, what happened to the overall market cap when, say, a country moved from 4 trillion to 10 trillion. So US saw this journey over a 15-year period, 1985 to 2000, and the market cap multiplied by 10 times. China from 2007 to 2014, the market cap multiplied by almost 4 to 5 times, which essentially means that large part of market caps of these companies would have been in sync, considering the kind of growth they saw in that period. So sometimes when we are seeing larger mega trends, it becomes difficult for us also to value these companies. It is not easy because we need to bring a mindset change. When a company or a segment is growing at 30-40%, the company is getting market share in that, improving its operating leverage, and we are seeing growth in the tune of 40-50% on earnings, and we see it sustainably over a period of 4 to 5 years. It becomes difficult as to how you value the company, because market is today valuing these companies at 50x, 60x, 100x, because the ROEs and ROCs for these companies are, say, in the tune of 20 to 30 to 40%, depending on what segment we are dealing with. In FMCG like HUL, it's upwards of 100%. So valuation is something that will be a challenge. You'd have to build in mind the kind of the addressable market. If the addressable market is pretty huge, and if the longevity of earnings growth is pretty high, I think most of these companies will continue to trade at a slightly higher valuation than what we are used to. The trick to invest in these companies is that every time you see a decent dip in the markets, which we definitely see 2 to 3 times a year, these are the companies where you should start building a small position at first, maybe 20% of what you would want to allocate. And every time you get a chance, you keep adding on. As long as the performance is coming, the growth is coming, you keep building these over a period of time, because it will be very tough for you to take a call to buy a company at 50x 1 year forward multiple today. Vanshita asked, are there any emerging companies that investors should keep on premium segment? So, Vanshika, there's a lot of hard work that you'll have to do within this space. We are seeing, of course, a lot of trends within a lot of smaller companies, and we are continuously evaluating them. These would be companies within the 500 to 2,500 crore market cap range. Some may be closer to 5,000 crores as well. But of course, there are enough companies, enough emerging companies and a lot of the companies that I've mentioned here, I think within them also you'll find a lot of sub-segments or companies that are mirroring themselves to grow like some of these companies. Say, for example, Gargi. It's a small jewelry retailer, largely into silver or non-gold kind of jewelry or very ethnic kind of jewelry. And if you see, their growth has been phenomenal. Of course, the legacy is P and Gargill, but this is one segment which they have carved out of their business and is doing extremely well. If you look at Core, the story is similar. When we come to MedPlus, there are still doubts on amongst a lot of people as to how this whole online medical tech will evolve. But my sense is that these guys will continue growing at 30 to 40% kind of growth, and eventually we'll see what happened to Zomato within these companies as well. So, of course, a lot of emerging companies in this sectors, and if you keep your eyes open and if you track results regularly, that is why what we are trying to do is through our small cases, two small cases, which is one is earnings momentum, and other one is mid cap and small cap thematic portfolios. We are trying to uh, buy companies which we see a larger trend, and most of the companies that we are working on. The only drawback of a small case is that we can buy only NSE and BSE listed companies and not SMEs. But I think we have enough ideas which we'll keep adding to. So, say for example, V2 retail is something that we really like post the numbers, and we believe that uh, the kind of vision that the government is showing for the next 3 5 years, there could be a transformation here in terms of valuation. Most of the messy companies like Shoppers Stop are trading at 15 times EV EBITDA, whereas V2 retail is trading at 10 times EV EBITDA, but much better growth, much better profitability. So you keep your eyes open, or you look at our own small cases, you'll get an idea about how we are doing what we are doing. Pankaj says, hello Piyush, thanks for providing this content. Your video on Krishka was interesting. On valuation size, this Dixon is trading at 180p, while Keynes is trading around 110p. PG Electroplast has more reasonable valuation. How do you see growth coming in? And if you could comment on your small case performance. So, see, as I said, if you look at trading cases, let's give you an example, unrelated. But when we presented on a company called Insolation Energy in March 2024, the company had already multiplied 12 times over the past 12 months alone. And the valuations when we were investing was close to 120x trailing. Now, when I looked at the forward multiple, it seemed far more reasonable. We were getting the same company at forward growth, about 6 quarter forward growth of about 14, 15 times. So, when we are seeing this kind of explosion within the segments that a Dixon is operating or a Keynes is operating, of course, today the valuations are pretty high. But you will get your chance within these companies because the growth that we are seeing over the next 5 years, such longevity of growth, such kind of asset turns, and such kind of ROE, ROC. One golden rule that you should remember is if a company is growing at 20-25% earnings and the ROC of these companies between 25-30%, which means that whatever capital it is generating, every year it generates more and more return on the capital employed. uh, these are the companies that you do not let go, and some of these companies will fall into that framework. Hi sir, AVP Motion has written, hi sir, will there be impact on old Indian brands that already are at inflection point? uh, Anyone who doesn't evolve with the consumer choices, of course, will be impacted. Companies which have first mover advantage and they continue to do well and continue to be open to what is happening within the consumer space, I don't see a reason why they will not maintain their leadership position. And on the small case performance, I think so. We were in both our small cases, we were sitting on a good amount of cash because similar to you, the concerns that you had in terms of valuations, we also stand with those valuations. But incrementally, every result season, we are getting 2 to 3 ideas which we believe will do extremely well over the next 3 to 6 quarters. So I think over the next this quarter and next, by then, I think we will be largely 70-80% invested. You will see, again, small case, when you're investing, you have to keep a time frame of 3 years. Every business that we invest in, we believe that when the inflection point comes in a business, it's a 2 to 3 year cycle where the earnings double in that period. And if earnings double, in most cases, the stock prices also double. So while we've got a lot of questions around why we are sitting on so much cash or in terms of performance, but it has largely shielded us with a lot of volatility. Of course, it seems that we are missing out on a lot of action, but we are not. We are in for a 3 year cycle, and over a 3 year period, if most of our companies deliver 100% earnings, I don't see why our small case portfolio should not double over the same period. Last year has been an aberration. It has spoiled us, see, believing that every year we can generate these kind of returns. No, these were exceptional return years that we saw. If we can compound at if our portfolio earnings is compounding at 28, 29%, that will be the compounding that we'll see on the portfolio level as well. I think which is where our larger focus is. We think about risk first and then returns. For us, capital protection is the number one thing that we focus on. And after that, we are largely, even when we are preparing an investing document internally, the first 4 to 5 pages are largely about risk. Then it is about the investment argument, and then, of course, the exit strategy. Uh, Amongst this, allocation plays a key role. Within small case, unfortunately, we have to keep an equal weight portfolio. But irrespective of, like in mid cap and thematic portfolios, we are a little more aggressive with our weights. We have 6% minimum weight on each of the companies, while in earnings momentum, we have 4%. So that is all about small case. So this is what I'd had to share about the entire theme. If there are any more questions, I am putting my email on the chat box. And if anybody want to ask, not in the chat, but would want to raise their hands and ask me questions directly, I'm happy to answer those as well. So free to answer any more questions if anyone has, or I've shared my email address. Karthik is asking my views on creative new tech. So we've constantly on our social media handle on Caprize. I've mentioned about what our views are. I think it's a lovely management team, and they are doing everything right in terms of the business strategy. Over the next 2 years, you will see fruits of their strategy, and I believe that this is one company that will uh, grow sustainably. You won't see a lot of earnings volatility here. They are taking smaller steps. They understand the risks of growing too fast, and which is where I think I love why they are taking the measured approach, but at the same time trying to grow much faster within the Honeywell space. Mitesh is asking my view on Oriana Power. I think I have continuously shared our view on the entire solar energy space. We continue to be very bullish on the space. Oriana Power is largely CNI space and the private space. They will do extremely well, and my sense is that if you again have a 3 to 5 year view, this is one space that will surprise you even beyond 2030. So every time you see a small dip in any of these names, I think you should latch on to most of these companies. Samveg is asking, how do you see the rural consumption theme? So Samveg, rural has was one piece which was very distressed. We saw this entire consumption premiumization theme as largely urban over the past decade, even in the last 4 5 years. And but what signs that we are seeing is, with the present government largely trying to be more inclusive, and because of the compliance, the coalition nature of the government that has been formed, I think we'll see a lot more SOPs, even if they are of socialist nature, or might eventually the entire capital that will be investing within the rural India would come from people like us. But a lot of money will be pumped in the rural space, especially within tier 3, tier 4 kind of towns. And you will see over the next 12 to 24 months how the consumption theme evolves around the rural segment. And I'm very confident that this will revive. So I think those were all the questions that were there. Thank you so much, everyone, for joining us again. And sorry for the mess that happened earlier. But I'm glad that I could have this conversation today itself. We'll keep sharing about a lot of our other trends that we are covering here at Caprize. A large part of our aim is to take our deep research expertise to the masses. Uh, we understand that most of the people today who have logged in might not have enough time to do the research, visit companies, visit plants, and listen to earnings calls, and then invest in terms of the right allocation and have a right exit strategy. So our focus is to have make a lot of the masses financially independent over a period of 3 to 6 years, and which is what we will continue to do. And as of today, we have just a small case that we have to offer. Rohit asked if you have any research offering. We do have a research offering in terms of platinum, gold, and silver, where we share our research. We share what the kind of visits that we do. Because yesterday in one of the podcast sessions, someone asked me, uh, "What is the edge that we have as a firm?" So honestly, there are a lot of PMS houses, AIFs, mutual funds, and investors on the social media who are doing similar work. Our only edge is that we do not sit in office. We are out 20 days a month. Our team is constantly doing channel checks in terms of meeting unlisted players, meeting the entire supply chain, trying to get as many insights as possible uh, for any segment that we try to invest in. And that is what gives us confidence to hold on to one particular company for a longer period. Gravita being a classic example where we bought at 150. We did a lot of channel checks, research, met a lot of unlisted lead recycling companies within India, got a broader sense of how the industry will play out. And even today, we have not sold anything that we owned 3 years ago. We bought at 150, 160. Today, it is close to 1500. So that is the kind of wealth you'll create over a longer period. So to all our small case subscribers, do have patience, and we will deliver based on the work that we are doing. I'm confident that we'll do our best to give you as much return as possible. But our focus is on our process and our framework. And as long as any particular company fits our framework, we are happy to add that to our portfolio. Beyond that, even if we have to wait for 6 months and not allocate, we are happy holding cash as well. Thank you so much, everyone, for attending. It was lovely talking to all of you. Any questions? I have sent my email on the chat box. Appreciate you joining at this hour. Bye, everyone.